Hi, my name is Jordan Wilson. Today we're going to begin our look at exchange-traded funds, which are a predominant instrument for passive index investing. But there's also mutual funds that are passive index funds. We spent a lot of time looking at the advantages and disadvantages of open-end mutual funds. And a big disadvantage was the management expense ratio, the cost structure that made it difficult for active asset managers to outperform their benchmark. So you're seeing a lot of mutual funds just throwing in the towel and saying, if we can't beat them, we'll join them. So you're seeing more and more standard open-end mutual funds that are now index funds. So all they do is they track a designated benchmark index for a specific style. Maybe the S&P 500, which is US blended large caps. Maybe it's the Russell 3000, which looks more at US smaller to mid-cap stocks. Maybe it's the TSX 300, which again would be a mix of the Canadian composite index. You may see some closed-end index mutual funds, but usually they're open-end. And when we looked again at mutual funds, we discussed the pros and the cons and the differences between open and closed. Now, an open mutual fund, you're still buying and selling through a fund company. And that gives rise to some potential liquidity issues, even if you're just investing in a passive index fund. Now, when we talked about costs with open-end mutual funds, one of the costs was the sales commission when you buy or sell the investment. The front load, the back load, declining load. I'm not sure you'd see any loads or sales commissions associated with passive index mutual funds, and I would never suggest that you pay a load for a passive index mutual fund. There's just too many other options out there in this field. And since they're only trying to replicate a benchmark, why would you pay for that privilege of buying their fund in the first place? When we talked about MERs, the expense ratios, we'll see because these are passively managed, you won't have that actual management fee to the active managers. So in a passive fund, the fees should be extremely low. You're still going to have the administrative side and other costs. And you'll also have the economies of scale that we discussed. If you have to pay 5 accountants and rent a building, it's easier to spread that cost over 10 billion in assets as opposed to 10 million. And again, index fund is just trying to match the market return and how they replicate the index full. They buy everything in its proper weights, all the way down to synthetic, where they use derivatives to replicate the market. You're going to see possible tracking error. You're going to see cost fluctuations based on the timing of their transactions as they add or delete assets from that index when they change. But the goal is to try to market match as closely as possible. Exactly as we saw in the previous episode on the keys to passive investing. Now, exchange-traded funds are very, very similar to mutual funds. But there are a few differences that are worth going through, and that's what we're here for today. So an exchange traded fund versus an open-end mutual fund. They both invest in a collection of securities, derivatives, etc., to recreate that benchmark if it's a passive investing. Most ETFs are passive, although in recent times we're seeing an increase in actively managed. ETFs are still, on a number basis, relatively small versus the number of mutual funds out there, but it continues to grow. And when we saw the previous episodes, we see that over time, over the last 10, 20 years, there's definitely an increase in the number of passive funds on offer, and a huge increase in the assets being invested in those funds. And I don't think that's going to change unless active managers can start demonstrating that on a consistent basis over time, they can outperform their indexes. So ETFs differ from open-end funds because they trade on authorized stock exchange. You can buy and sell continuously throughout the trading day. If you remember with open-end mutual funds, your relationship is with a fund company and you buy and sell based on the close of business net asset value. And the fund will redeem the shares or the units, and you will buy shares and units from the fund. ETFs, you're buying and selling with other investors. Because of that, there's a fixed number of shares that are issued with ETFs. It's not unlimited. So if I go to a open-end mutual fund with $10,000 and they haven't closed that off for new investors, they'll issue me additional units at that NAV. With ETFs, I've got to go on the market and buy and sell. And that creates a supply-demand pricing system. The more in demand an asset is, the higher the price it'll drive. That said, because they're just passive index funds, ETFs tend to trade at their net asset value. And finally, if you're buying anything on a stock exchange, there's a good chance you're going to pay a broker transaction fee. And that's different than a sales commission with a mutual fund. And now I think the prices all tend to be under $10 a trade. So it's not that onerous. But even little costs can add up if you're continuously transacting. We looked a bit at closed-end funds back when we covered mutual funds in general. They're quite similar to ETFs. Both have a fixed number of shares. Both trade on authorized stock exchanges. Therefore, the share price of both is based on supply and demand. And I think what you find, though, is that closed-end funds, relatively speaking, tend to be more active than the ETFs. ETFs tend to be more passively managed. Closed-end mutual funds, probably relatively more actively managed. And I think you'll tend to see higher premiums and discounts on the closed-end funds. And I think in part that would be because they are more actively managed. So there's that value in the quality of assets they hold and the quality of the management team. So if Warren Buffett is running my mutual fund, maybe I'll pay a premium for having him behind the wheel than Ken Lay of Enron or Bernie Madoff. So I think in the closed-end funds, you tend to see a slightly higher variance from net asset values. Common shares, also in many ways quite similar to exchange-traded funds. Again, both have a fixed number of shares issued or outstanding. They both trade on stock exchanges. And so the share price is based on supply and demand. Both pay transaction fees. The big difference, though, is that an ETF is a portfolio of many investments. It's usually, not always, but usually diversified portfolio. There are some concentrated indices that I would say are not diversified. But if we just sort of look on a numbers game, then it would be diversified, at least within its market sector or subsector. And obviously, common shares are not diversified at all because you're buying or selling a single entity. And yes, you could possibly make an argument that companies like Berkshire Hathaway, which is the investment holding company for Warren Buffett, is a common share, and it's also pretty well diversified. And that would be true, but again, it's slightly different concept than if I'm buying an index ETF of the TSX 300 or the Morgan Stanley Swiss index. So that's kind of the similarities and differences with exchange traded funds versus the standard open-end mutual funds, the closed-end funds, and common shares. Okay, that's it for today. A relatively short episode versus at least some of the other ones that we've done recently. Just wanted to give you an introduction to exchange traded funds and an overview of how they fit in versus open-end mutual funds, which we've covered in great detail, closed-end funds, and common shares. Next up, we'll dig a little deeper into exchange traded funds and compare them a little bit more closely with open-end mutual funds, because if you are going to passively invest, open-end mutual funds and ETFs are probably the two key vehicles to use. And depending on your personal situation, there may be one that's a better fit for you. So we'll sort of lay out what the differences are and things to consider. And I think just in general, if we look at Canada, Western Canada, often ETFs will become the preferred investment vehicle because mutual funds, even the index ones, tend to have a higher cost. But that's not true in all jurisdictions. So we'll go through that, and you can make your own decisions based on where you live and who you trade with. Thank you for listening today. We'll be back with a little bit more on exchange traded funds starting in the next episode.